I just wanted to start by welcoming you all to, I think this is going to be Lion's 29th annual general meeting, because we would have had one shortly after Lion was listed in 1997, and here we are 29 meetings later, which makes next year a pretty big year. And I'm not sure how many companies on ASX would have persevered for quite so long. So we all feel that that's quite special. And we do appreciate all of you turning up. I know there's people who've travelled from Queensland today. There's some from Western Australia. There's definitely some from New South Wales, country Victoria. I'm sure I've missed a few there, but we very much appreciate the gesture of people coming. I've managed to convince one of Lion's larger shareholders who's never been to an AGM before in her life to attend. I'm not going to name her, but she knows who she is. And I very much appreciate that as well. It's fantastic to have that kind of turnout. A little bit later on, we're going to be serving some refreshments before we get into a little bit further of some company presentations. You'll see some people handing drinks out. You know how they say to be really nice to wait staff? It'll be worthwhile because they're all my kids. They'll give you a drink if you ask nicely, but and any feedback on me, well, I suppose just go for it, hey? As we stand, I think at last year's AGM, our NTA was roughly, I'm going to get this wrong, in the low 70s. We were trading in the very low 50s cents per share. That was 12 months ago. NTA right now, or at least at the end of October, was 98 cents per share, a bit above after tax. And you could buy those shares in the market this morning at about 88 or 90 cents per share. So we've had a wonderful year. And what I want to tell you a bit about is what that year's been, give you a bit of a snapshot of what we expect from the future. And then after we've had some refreshments, I want to introduce you to some of our investees as well, so you can hear from them about why we invested in them, rather than me telling you all about it. To set the scene, Lion Selection Group is a listed company. You can buy and sell our shares, or preferably buy more than sell, on ASX. We're a company that then invests in the micro-cap resources space. This is a space that I think a lot of people do want to invest in, and the tantalising thing about that space is that you can obtain 10 times, 50 times, you can get some extraordinarily strong returns if you get everything right. Timing, stock selection, you name it. And that's what we try to provide exposure to. I know there's a lot of people who I meet around conferences and things, and they understand this very much. That's why they go to the conferences, to hear about these companies, but they know there's two big challenges which they face, and these come up all the time in conversation. The first one is that they understand that mining is cyclical, but they don't understand the cycle. So for them to be able to invest, what they're petrified about is whether or not they're getting their timing right. Because I think they understand if you invest at the top, you'll be carried out sideways, and that will affect the return on your investment. And the second thing they understand, and I suppose I'll put this in a polite way, is that there are many, many versatile entrepreneurs in this space, and they can't tell the difference between the good ones and the not so good ones. It's a bit of an exercise in kissing frogs. You kiss enough frogs, you find a few princes, and we've kissed a few for you today, folks. I'll introduce you to them later on. The thing is that you're trying to find stocks in a very, very large space that have an asymmetric distribution of risk. You've got much, much more upside than you do downside. That's the dream. And finding those from an extraordinarily broad space. On ASX, there's about 18 or 1900 listed companies. Almost 700 of those fit in the micro-cap resources space one way or another. So you're trying to sift through more than a third of the population of listed companies in order to make these stock selections. So the biggest selling point that I can give you about Lion Selection Group is that that's what we do, and we pool it. Now, if you want to come to our meetings and see companies or read our reports and then stock pick a few of those, that's your business. What we try to do is aggregate that performance and turn it into something that you might not be able to get from any of those, which is we watch the cycle, we try to time our way in, time our way out. We think the top of the cycle was 2021-22. That's when we sold $95 million worth of investments. And then we held on to most of that cash, and we've been pushing it into a much, much weakened market, which collapsed in the years that followed those sales. We've got a mining investment team who spent many years in the sector, and we watch over that investment for you. We monitor the companies, we speak to people. And I think going with that is networks. So we can tell you a bit about people in the space, the good ones and the bad ones, and who we want to work with. So I got some gory stories on all the fellas up the front here, but probably cuts both ways. I'm very familiar with the expression mutually assured destruction, so we're not going to get into the stories. Suffice to say, this is something which you genuinely need to invest a lot in this space, is ability to understand people and know what they're about. And our investment objectives, we're not going into this exercise hoping that we're going to make 50% on our money in any one investment. We're going in thinking that we've done an assessment of this company and thinking that we have 5 to 10 times upside on the price at which we invest, sometimes more. It's hard to impute growth into that. Growth comes on top of that in some cases, but we're investing for these multiple returns and we hope to aggregate those. And where we get it right, we'll grow our shareholder value. That applies to all of us. But we're also in a position where we can try to provide dividends as well. We paid one in September, which was only a couple of months ago, which was 2 cents per share. So people ask about the policy. Our policy is if we've got franking credits and we can generate enough of a profit to be able to push some cash out as dividends, then that's what we're going to have a discussion about around the board table. I said before we've had a terrific year. I just want to hit you with a few of the highlights. First one is we've been very busy investing. We've put three new companies into the portfolio that weren't in the portfolio when I spoke to you last year. This is a concentrated portfolio. We're up to 11 investments. So, adding 3 is a pretty big milestone. We've made 10 follow-on investments. In fact, I think we've followed on in many of the companies you're going to hear from later today. And in the time since the last annual general meeting, we've invested $16.3 million. So of the portion that we have active in the market, that's a pretty reasonable part. We've also made successful exits. Now, I don't want you to think that we're planning exits from anything in our portfolio. Everything that we've got, we are very happy with its progress and we're intending to see it go through a market where the rising tide will lift all boats. We've got out of a couple of things here which were opportunistic. Alto Metals has been merged into Brightstar. We were very happy to see that happen. Makes a big, strong company. We did sell something which was quite mature. We've been involved with a company called Erdene Resource Development Company in Mongolia, of all places, for a number of years now, well over a decade. We had about a $2.8 million cost associated with that investment, and we took $12.3 million out of the market. So that's what underpinned the September dividend. You would note that that dividend was nowhere near $12.3 million worth of return. So a lot of that's gone back into the pool for shareholders to benefit from in the future. And Atlantic Tin was sold into a takeover, which was also a long time waiting. Also a very profitable exit as well. So we're watchful for these things. When the opportunities arise, we'll take advantage of it. And that's what we intend to use to feed into these dividends, which I've already spoken about. That was fully franked. Now, I don't normally make a big deal about fully franked, but the amount of people who've said to me, oh, dividends in the past have been unfranked. You ask my kids who are wandering around, when I give them money, they say thank you. They don't say, oh, you didn't frank it. Well, now we've franked it. So we're all very pleased about that. The portfolio, and this is not a reflection on the year, this is a reflection of a milestone of where we are. We've invested $43.3 million since we exited Indonesia in 2022. That's now worth 96.1. In fact, it's probably a bit more than that. That was cast at the end of October. In fact, the key contributors to that value uplift, all 5 of those companies are here. There's been a bit from some of the others, but the key components are going to talk a little bit later on. And I would add that I think that value uplift is far more a recognition that they're in the gold space in many cases, as opposed to the growth which we might have assessed is possible or even highly likely that sits within their valuation cases in our books. So there's still a long way to run on those things, and that's a wonderful return, considering that I don't think we even think that the boom had started when we put this money in. But the final thing I'll say about 2025 is that this is the year that mining indices bottomed. Commodities in many cases also did. Gold a bit of an exception to that. And between August and November, mining indices actually outperformed most of the rest of the market. That's the first time that's happened for many years. And we see that as a very, very, very significant sign. I'm going to talk a little bit more about the cycle in a moment. What we do is a process which has been developed over decades now, and we've refined that into some notes that we could put down on one page. People always ask about this, but this is what we plan to do. This is what we try to stick to fairly rigidly. We align our investment to the cycle. If you're investing at the top, you'll be very, very frustrated before long and you'll sell out and probably never come back. We try to align our investment to the bottom of the cycle and then try to make our exits as we're approaching the top. And we've been quite successful in doing that, exiting Indonesia and then putting our money back into the market recently. For a lot of you, I suspect you look at companies in this space and maybe don't see as many as we do. I know a lot of people who will talk about 5 or even 10 companies that they've looked at, some of which they've invested in. We have deal flow which provides hundreds, sometimes 1,000 opportunities in a year. We're seeing what we think is a statistically significant proportion of the deal flow which exists in this space. So we know when we make an investment, if we're picking 10 to 15 things to invest in, they are the best things and most suitable things that we have seen. It's not just the best thing out of the 10 that we've seen. So deal flow is incredibly important to know that you're picking the best things. We're backing people. We're putting together a valuation, and that valuation, despite looking at very early stage things, is actually quite sophisticated in its approach. The sensitivities on valuations in this space come down to the dilution that you think is going to take place as you move through to project development, and the amount of metal that you can put into a model. So there's a financial decision and there's a geological decision to make around what that value is, and neither of those are things which companies promote, so you need to make your own mind up about those. And we look for an asymmetrical distribution of risk. We want far more upside than there is downside. And two great examples of this is that you would notice we've put more money into gold than we have into anything else. That isn't because we love gold's gold price, although we do. Gold is extraordinarily simple to separate and sell, so it carries a very low project risk profile, and that is very attractive when it comes to offering a low risk portfolio to our shareholders. The other thing is that we've decided to focus in Australia for this cycle. And part of the reason for that is that it's far better to be focusing in a place like Australia where you know where you stand in the courts, you know where you stand in the legal and commercial process. Even if you have frustrations with the governments, I can guarantee you that I would have far more frustrations with the Burkinabe government at the moment than I would do with even the Victorian government. So at least they don't confiscate projects, although maybe that's coming next. You never know. So managing risk is hugely important. And before I cast my mind too far forward, I thought I'd just capture a few thoughts on exactly how the mining sector has performed in this year. So 2025 has been a colossally important year. What I'm showing you is prices of two Australian indices going back to 2020 and going up to early, I think it's April 2025. And what you can see there is the resources sector versus the industrial sector. Take the ASX 100, two component parts, plot them separately. Towards the end of that, you can see that the resources sector has underperformed whilst the industrials were running away. So this was the story of 2024 in particular, and we started 2025 thinking very similar was going to occur. Now, this shows a fairly mild correction, I think you would say, for the big cap stocks. They're dominated by BHP and Rio. Their collapses in the last 3 years have been fairly mild. I think the maximum down for both of those was about 25%. If you were a Teck or an Anglo or a Glencore, other global majors, you would be talking about being down circa 50% in the same time frame. I'll add a couple of other metrics to that. These aren't indices, these are lines that I've calculated, and I've just used a median, which is a statistical measure across large groups of companies. I've got a group of gold juniors, and I've got a group of micro-cap resources companies. And just to put some numbers to that, the proportion of falls which have taken place there, on ASX, circa 33% is what the big end of town for mining is down, whereas the micro caps have lost almost 80% of their value. And that's to the lowest point in the market, because where this chart goes from here, and I'm so glad my animations are working, when we add the rest of 2025, that story actually brightens. And for a period of time there, the big end of town miners have outperformed the big end of town industrials, which I think is tremendously significant. But you can also see that, led by the golds, the micro caps have lifted themselves up off the floor. So after a circa 78, 80% fall, that group as a whole, and when you think about it, medians don't lift because one company goes up. That median price has gone up quite significantly, and that's been driven by gold. But the real thing it's been driven by is the sentiment of gold saying, people, this is a good place to be investing. There's some wins on offer, and people have been putting their money into that space. Liquidity is what has driven that. So this is the signal, we think, one of them, that we're going through an interesting time in the market. And what we've been waiting for is the turning point. Now, Robin claims that someone stole his bell. I think when we were actually leaving our old office, we auctioned off many of the little trinkets that we had in the office, and someone bought it. They didn't steal it. And I think it was actually one of these two fellas too. So careful who you accuse. If we were ringing the bell, the appropriate time to do that may very well have been in April this year. So here we stand saying, well, perhaps that bottom turning point is behind us now. There's one other piece of evidence I would add to that, and I don't want to get too deeply into this, but liquidity is a signal of money coming in or leaving the market. And the very best way to look at this is not in share prices, because they look backwards, It's looking at what money has been raised. And because of the nature of ASX and the way they control data, it's actually quite difficult to figure that out on ASX. But even secondary raisings into existing companies, the most liquid year that we had on ASX for miners at a time where we were judging that by capital raisings was 2008, which was when Rio Tinto executed an extraordinarily discounted rights issue to save its ass. To rescue its balance sheet from being over-leveraged in a horrible market. So you can't actually look at secondary raisings. We look at IPOs, listing unknown companies on a market, and if you can list a lot of those, the market must be supportive. So I've got a list here of going back to 1995 of resource IPOs per year. Most of these are exploration companies. And as we get to 2024 and 25, you can see 2024 has actually just tipped up above the number of 2024, which was kind of the low point. But if I break that out, and I meant to say in the highlights that one of the things I think I'd give us a very, very high mark for this year is recruiting. We've added to our team, and we're giving ourselves 10 out of 10 at this stage. So we've got some data which has been compiled on the right here by Charlie. Please come and say hello to him later on. He's part of the team now. This is quarter by quarter, number of IPOs and also capital raised. And where this draws my eye to is in quarter 1 2025 when there was an absolute low point. There was no new IPOs that raised any money. There was 2 listings, and they were both compliance listings onto ASX. In fact, one of them that compliance listed in January 2025 took until August to make its first trade. So I wouldn't say that particular example was a great indication of liquidity. But quarter on quarter since, we've gone to more capital raised, more listings than we had in 2024. And that's amazing because that's an incomplete year, and it's also only really 3 quarters. So we think that 2025 has turned through the bottom there on liquidity as well as just watching those prices. What can we say then about the lion clock? 2021 and 22 roughly was the top of the market. It depends what indicator you want to take. It was fairly recent for the majors. It was very early for the micros. 2022 through to 2025, let's say, we had the mining bust. The majors fell somewhere between 25 and 50%. The micro caps collapsed well over 75%, stripped off of their value. And when I spoke to you last year in 2024, the lion clock was at 4 o'clock. It's moved on from there. In our quarterly, which came out at the start of this week, what we said was that clock is moving through 6, which is exactly what those shaded arrows mean. You may take the view from what I've said that we've actually passed 6. The thing is, this liquidity will come and go a bit as we waver through the bottom. So I don't want to say we're rushing into 7 just yet, but I'm very, very sure that we've passed well beyond 5. So I'm convinced that we are going through, or at least almost past this important time in the cycle. So in 2025, we see liquidity improving. This is a massive, massive signal. And the expectation then for the boom, this is where the thing that excites me the most sneaks in, because we know from history that mining booms involve all share prices of miners being lifted. Liquidity across the space helps everybody. The better companies perform the best for sure, and you want to be invested in those. This particular boom, though, looks to have special characteristics associated with it. We've already seen a red hot start from gold, and we see the whole industry, no matter what commodity they're invested in, being underinvested in the supply that they need to be delivering into the perception of increased demand, which is coming. That is one of the biggest fundamentals which exists for this coming boom. So rather than the boom which lifted BHP and Rio by modest amounts in the sort of 2016 through to 2020, 2021 era, I think we can expect a much, much more aggressive cycle, and that may very well benefit juniors more than the majors. We had a really good debate about that the other day, but if you're extremely leveraged to iron ore and coal, you're probably not going to be capturing much of the uplift that's available in critical metals, or even what's going to likely to happen in gold. So we feel very comfortable in the space that we're in. Not trying to compete with BHP and Rio there. I think our governance processes would probably not be such a thick book at the end of the day. So Lion's portfolio, this is a snapshot of it, and I don't intend to go into these in any detail because you're going to get a fantastic rundown on a couple of these in a very brief run through a little bit later on. Suffice to say, we're almost encircling Australia now. We're in New South Wales in a couple of cases, Queensland, Northern Territory, many in Western Australia. And there's a spectrum there from extraordinarily early stage, which is risky and we do sparingly, but we invest in when we think that there's a massive potential prize there and it's worth taking a punt on. an educated punt at that, and right through to a couple at the top there, which are somewhere between producing or almost producing gold at this stage. So we're not far from having producing companies in our portfolio as well. What we wanted to give you a perspective of, though, and I have to thank my colleague Craig for this, because this was not only his idea but also his construction, and I think this slide works remarkably well. Whenever you see a small company present, they're always going to say, hey, this is why we're special, and look at all this news flow that we've got coming up. So this is what 2026 looks like. It took a very long time to animate that. There's about 75 different animation steps in making all of that news flow appear. And we're pretty confident that the major parts are there, but these guys over here are probably going to tell me I've missed something. We've got one company going from tiny producer to probably a larger producer. We've got one company that towards the end of next calendar year is very likely to be in production for the first time. And I think if you were to add 2027 and 2028, you'd see some more gold stars for producers coming onto that page. Likewise, we've got the biggest new rare earths discovery in Australia, which is something that we're very pleased to be invested in. We've just bitten off some tin exposure. And whilst iron ore looks like something that could become part of a flooded market with the contribution of West African iron ore, a very exciting and easy to make iron ore discovery and progress in the Pilbara, which we've also added to the portfolio. So we feel that this is rounding out very nicely. I'd completely forgotten to mention the hot chilies, Craig, so I pressed the button and they appeared. So the other thing we wanted to mention about this slide is that everybody has growth, and I'm going to have offended a number of people over here, but there's a number of companies on this slide which have the potential to generate new discovery growth. And that's the kind of thing where you don't just get a share price going up 10x, you get the value of the company going up 10x or more. And that's because you go from having nothing, holes in the ground, which are a cost and not a value, to all of a sudden something stringing together. And when you've got a valuable new deposit, that's where the market is prepared to put very large numbers on it. There's a number in our portfolio there, which I think in some cases could materially affect the value of Lion if they succeed in what they're looking for. So we're very pleased with that as well. Those hot chilies might move around over time. I did debate with myself whether we needed a 1, 2 and 3 chili rating, but in the end, I think 3 chilies is enough because everybody's going to get a chili. Every child gets a chili these days, especially in this portfolio. Final thing I'd say about the portfolio is that all of those companies, as a member of the micro-cap resources space, is better funded than ever. Many of these have raised money in the last little while, and they're in a more supportive market right now. So thinking into 2026, the thing that drives news flow drives rewards, particularly in a good market, and share prices go up. Very, very well funded in order to be able to deliver on that. And as you deliver news flow, you de-risk, which does mean you mechanically add value to the value of the company. So 2026 strikes me as a year where things could accelerate and really take some form. I just wanted to make a couple of comments about outlook. There's all sorts of things you could talk about with gold, and I could spend 3 hours talking to you about the fundamentals for gold. Really, I think the best way, this is how I think about gold, is that over a long period of time, gold has not been constrained by the cost that people are prepared to pay for it in order to pass that cost on to someone else, like copper going into a power line. Gold has no buyer interest that caps it. In fact, people who want to buy gold are ownership motivated and not price motivated. So here we have the price of gold going back to 1960 and 3 massive bull markets which jump out at that. Each one of those has some fairly similar characteristics, and that's what makes now so special. For a long period of time, you could argue that groups like central banks needed to own gold because the world was a volatile place. In 1992, the Cold War ended, and that brought about a period of time where central banks were selling gold. That massively depressed the price. But it wasn't long before conflict stuck its head up again. And in fact, there was a number of factors which pushed the gold price up that probably weren't conflict, but were gold sector related. And that's where the sector was buying back hedges, which it had put in place over the 2 decades leading up to that point. The global financial crisis introduced stimulus and probably the expression, some companies were too big to fail. That is probably the thing which in my mind has catalysed central bank buying again. And we've seen massive, or very, very large at least, annual volumes of central bank buying, which has underpinned the gold price. Has it driven it to $4,000 an ounce? I don't know. Whichever investor pressed the button that pushed it through $4,000 an ounce, it probably wasn't a central bank. But if you chew up that much annual supply by central bank buying, it really tightens the gold market, and it's something to look at. There are bigger buyers in the market, and in fact, the biggest buyer of gold, I think, in the last quarter has been Tether, which is a tech company which underpins stable coins that people have to buy if they then want to buy Bitcoins. Go figure why they're buying gold. But, we're in an interesting market. We're moving into a period, I think, of more conflict rather than less. And we may very well look back at now and say, well, look how well supported the gold price was. I have found, though, that if you say a number, as in what you think the price is going to be, it jinxes it. So I'm not going to say it because the gold price will fall tomorrow if I give you a price. The other outlook, and this is to equity markets generally, I think, is to say that we've seen a growth binge, particularly across the US market, but this has occurred in multiple places, and that's been very much tech dominated. You probably all read the newspapers. I'm not going to be telling you anything new here. If you take two key indices from the US market, the Russell 1000 Growth Index and the Russell 1000 Value Index, and divide one by the other, you get a ratio which tells you whether the market is far more interested in growth or far more interested in value. And that's been a tech-driven growth orientation, which plays out on that chart. So that's on the left-hand side, and that's well above average. The last peak in that corresponds with the dot-com boom, and I think you can see that we're well above the peak here. That doesn't necessarily say that there's going to be a correction, but I think it says that we've gone through a period in time, stimulus-induced in my mind, where a lot of the market has pushed money towards growth stocks rather than the safe ones where they feel that there's good value on offer and steady earnings. The other chart I wanted to present really was just to say, and this is from the Australian market, that the miners have largely missed that growth binge. The miners have got great growth, they've got great commodity price fundamentals in front of them, and they're making great earnings in many cases. Yet the miners on the Australian bourse are trading at a discount to the price to earnings ratio, which is applied to much of the rest of the market. And that trend goes back 5 or 6 years. So I think you could probably argue from that miners are overdue a little bit more of a share of the action, and I don't think much speculative interest has been pushed towards those. But if we find ourselves in a market where commodities are starting to head upwards, that sentiment will correct, and probably very quickly. The outlook for Lion, there's a bit more on this page. The boom is beginning. Booms lift all boats. It's a tremendous outlook, just generally being a boom. But as I said before, I think this one's going to be quite special in terms of the underinvestedness of the industry, which is going to put a lot of major miners and even mid-tiers in a position where it's much, much easier to buy juniors than it is to go and look for the new supplies of commodities and develop them themselves. So it's a good sign for consolidation. That excites investors, and that really lubricates markets when you start to get into the thick of the boom. But it also gives us an outlook of 5, maybe 6 or more years where we can say we have fair investing conditions. And this is a good time now to be deploying capital into, but then holding with the expectation that we're going to have good returns in that period of time. From a Lion perspective, we have 11 Australian investments in place. I'm not mentioning one investment, and Taz is giving me greases there because he knows that phosphate and Tunisia is very important, but we've made our future about broadening our exposure to Australia, and Taz knows that we love him, so we're not leaving him out. For the sake of the future, though, we're probably 11 investments into a target of somewhere between 15 and 20. So we're actually really well set as far as what the portfolio looks like. We've got $47 million worth of cash. I think I need to say net cash, don't I, Craig? But anyway, it's a lot of money, which is more than we've invested so far. So we're exceptionally well positioned to be able to take advantage of weak points in the market, like we've just gone through, new investments with a contrarian eye, and we've done a couple of those this year. And we see tremendous performance growth drivers in our portfolio. Like I said, the portfolio is well funded now. Those companies are going to be able to deliver news. They're going to be able to de-risk, and they've got the boom to play out on their plans. So that's a fantastic outlook for us. The last slide that I'll show you, and this is just the sales pitch, right? We're tremendously leveraged to gold. Gold is going nuts. So great play on gold. Our investment strategy is performing. The money we've put in the market since 2022 is up 122%. We're strongly funded. We can follow on. Some of the best opportunities that you would miss because you're not well funded, we don't have to worry about. And the mining boom is here, but it's yet to play out. So the outlook for us is very, very strong. I'm going to put a QR code up there on the screen for you. If you're not signed up to our what do you call it? Updates. We send out far more than you can see on ASX. They don't like us, putting our presentations and stuff in our quarterlies anymore. So you'll get podcasts, you'll get videos, all that kind of stuff. That QR code will take you to our website. Sign yourselves up. I'm going to leave that up there whilst we take some questions, and I think we're going to have some refreshments coming around the room. If you see a person wearing an LSX hat, they'll be able to provide you with something to eat or drink, I'm sure. So, folks, questions on anything from the AGM or the strategy session? Any questions from these fellas down the front? Save that until a bit later on. Oh, yeah, sure. So Ricardo's question was, there has been a reduction in Lion's percentage interest in Brightstar recently, one of our larger investments. What's all that about? And the answer to that question is we haven't sold anything. We've been diluted by the issuance of shares, and that took us through a threshold. So I think there's been several reduction steps. You get to a point where you've fallen, I think, by a full percent, and then you need to make a cleansing announcement to show that that's happened. So we arrived at that point. There's nothing in our portfolio that we want to sell. In fact, I'd say that most, if not all, we want to be investing more in, and Brightstar is no exception to that. I know they've had a rough trot in the market, but they had to issue a fair bit of stock to raise money when they were doing a deal to acquire Oramin. That took all the buying interest off the screen, and it came at a time where there was a bit of weakness slipping into the market. So I think we see from their last quarter they're looking exceptionally well funded, and they've just consolidated the whole of the Sandstone Belt, which has had about 4 million ounces mined from almost knee deep. So by the time they drill out the resources which they're after, I think it's an exceptionally bright outlook. So yeah, not selling Brightstar, just being diluted. Peregrine is an exploration company, and when you're an exploration company, you look for anything that you can find. We have invested in Peregrine because we really like the gold, almost said gold, the iron ore target, which they're going to be drilling, if they're not already, very soon. Peregrine's found a footprint of what's called channel iron deposits right next door to Mount Whaleback. So something that could feed very easily into BHP's infrastructure. And I think if you were to find somewhere between 100 and 300 million tonnes of very reasonable grade iron ore and good quality right next door to BHP, irrespective of what the commodity price is doing, it's probably quite a valuable asset. So we've done it for the iron ore, although I'd acknowledge that they caused one of the first modern gold rushes in the Pilbara by announcing something which was about that much of solid gold in a drill hole, and a bunch of prospectors went out and ripped the rest of the outcrop out. So if they stumble across anything more like that, we'll take it. Yeah, so the question was, where in the line clock is the gold sector, and is the gold sector further ahead of the rest of the mining sector? Paddy, I'd actually say that the line clock is driven by liquidity, not a single commodity. And if we address the whole of the mining space with that. So there's been periods of time in the past where something like lithium was running red hot and many other things were leveling off. Lithium was bringing liquidity into the space, and that's what was driving the clock at that period of time. So I think you could say that we're going through 6 o'clock now because of gold, and that's the answer to that. Something is bound to go first, and in this case gold has. It's actually very common that gold does that. I would also add, though, that there's been cycles in the past where gold has been a feature of the entire cycle, and there's been cycles in the past where it hasn't. The times where it's been a feature of the entire cycle, I think we've had conflict in the world, interest rates wobbling around, and varieties of uncertainty, which has made gold a thing which correlates quite well with other commodities. It's very difficult to forecast. If we were an exploration company, I'd be able to tell you how much we wanted to spend on drilling, and the only caveat I'd probably give you is whether it was raining or not, and whether or not I could get access to the site. So that's the excuses I get from these fellas over here anyway. We can't forecast because what we find is that, you know, a deal will come up, and it wouldn't surprise me, the phone will ring next week and we might have to deploy some money. It might be a significant amount of money, particularly if we're ready for it. Or it might be that we wait until February next year to do something. So it can be a difficult one. Having said that, we don't think there's a race to be putting money into the market. The mining cycle is going to play out, in my mind, over 5-6 years or so. And the analogy which I often give on this is that the top of the boom, you talk about things like, Cinderella went to the ball. She didn't have her eye on the clock. Midnight struck. Her dress turned back into rags, and her coach into a pumpkin, and all the rest of it. So, you know, that's the top of the boom. Nobody ever talks about what time Cinderella actually arrived at the ball. And I think, I can't for the life of me think that Cinderella would have got to the ball and said, has anyone here had like 2 or 3 drinks already? Because if you have, I'm just going to go. I think rather Cinderella would have got there and gone, if you guys are 2 or 3 drinks in, I'm just going to see if I can catch up. So, you know, I think the most productive thing I can say is that we want to be investing until probably 8 or 9 o'clock, and we're well off of that at the moment. So, and not stressed at all. In fact, the volatility that you see in companies at this junior end can be brought about by many factors outside of their control. So the things that we're in, heaven forbid, there's a bit of volatility that affects them, we'll be ready if there's a very attractive price that presents to just build our percentage aggressively. Yeah, so the question was, some time ago, Lion made an announcement, and I'm going to get the wording wrong here, but this was an action which was initiated by a company called PT Prima, which is an Indonesian company that has no assets in Australia. It was a related party of the managing director of a company called One Asia that we invested in many, many years ago. That particular managing director left the company along the way, and PT Prima was seeking some damages over grievances. I don't know, it's probably not fair for me to comment on exactly what those grievances were. Needless to say, we regarded those as being quite opportunistic on their behalf and not something that we should worry about other than treating it seriously from a legal perspective. Now, I think, I'm just seeing if I can eyeball Jane because she's the oracle on this. There's a date coming up. Is it mid-December, Janie? 15th of December is when that claim falls away, and it does so naturally because of the passage of time. We've got not many weeks to get to that point, and we need to wait and see what they do in that time. They were seeking funding for going on with their litigation, so I've got to say it looks quite opportunistic. Well, I'll tell you what, we could, it looks like the tempo of hand raising is sort of diminishing. Why don't we have a pause there, circulate by all means. We'll call you to order in not very long. We'll set up for some pictures here. Make sure you get a drink and something to eat if you fancy it. But from the perspective of the Lion AGM and Strategy Day, we appreciate your attention for that period of time. And what's coming next is quite exciting, fast-moving, and going to contain a lot of information for you as well. So we'll be back with you in just a moment, folks.